Well, good afternoon and welcome back, everybody. It's great to be here. My name's Helena Morrissey, and I have a number of roles, but I'm here in the capacity as a member of Edelman's Advisory Council, and I also offer some ESG specific counsel and advice to the firm. So it's great to be with you, and I'm joined by a fabulous panel. They're not just fabulous individually, but they also complement each other's strengths. We had a little change of lineup, and it turns out that I am the fixed income specialist on the panel, but not planning on working too hard on that front. So let me first introduce Alan Custis, who's sitting in the middle from me here, who's head of UK Equities and a managing director at Lazard Asset Management. He's worked there for 17 years, which is very impressive, and manages several UK retail funds. Rob James joined Premier Miton last year. He manages CoCo funds, which are contingent convertible funds, bond funds. I'm sure he will elaborate if anyone wishes to find out a bit more about that. Was previously at Merian Global Investors, where he was the co-manager of the Merian Financials Contingent Capital Fund. You might have to also explain that, Rob. And Rob has been a financial sector specialist since 1994. Carolina Espinal, last but not least, is a managing director in the fund investments team at HarbourVest Partners and a member of the firm's Global Primary Investment Committee. She focuses on managing European venture capital and buyout partnership investments. So we have, as I say, different perspectives drawn together today. And I'm going to start by asking each of the panelists to talk for 3 or 4 minutes on the big question, which is, what do you think is the big theme that will dictate the outlook for financials next year? And I'm going to turn first to Alan, who's something of a generalist here, to give a sort of background view, a macro view.
I'll take that as a compliment.
Your thoughts. It is meant to be a compliment. It is meant to be a compliment. There is room in life. We need both generalists and specialists, and you are our generalist. So, Alan, give us your
Sure.
broad picture view of the outlook for financials and the big themes.
Thank you, Helena, and thank you to Edelman for inviting me to talk today on this subject. As the introduction suggested, I am a generalist. I'm not a financials or bank specialist, and my colleagues on the panel, I'm sure, will be able to delve a lot deeper into this. But I thought there's a lot of things that have gone on clearly in the last 18 months for banks, and I think that as we sort of project forward into 2022, there are a lot of reasons to be a lot more positive on banks than we have been probably since the global financial crisis. As I left my desk today, and I appreciate that these numbers can change, the bank sector was up about 20% for the year, and this is the best return we've seen since 2012. Obviously, that's on the back of what was a pretty disastrous year for banks last year. But what we have seen in the UK economy is we've gone from the steepest recession we've had since the Second World War to the fastest recovery we've seen. And in fact, the expectations are that we will get back to our UK GDP glide path either in Q1 or Q2 next year, so some 9 quarters after the recession kicked off in March last year, rather than the standard 16 quarters, which is historically how we've kind of measured the recovery phase. So with that as a backdrop, I think the banks have clearly played their role in the last 18 months. They've supported industries, they've supported individuals. And I think as the bad actors from the global financial crisis, I think they have rehabilitated their public persona somewhat since March 2020. So what makes me positive on the sector as we move into 2022? My points are threefold, and they're the 3 R's. It's not the 3 R's we normally refer to. They are rates, regulation, and returns. Somewhat less exciting than the other 3 R's. But in terms of rates, if you've been an investor as long as I have, I remember inflation. But we've had deflation for the last 4 decades. And so there are a lot of investors who basically have not experienced inflation at all and what the impacts are on that. And we know why deflation's come about. It's been technological changes, it's been global outsourcing, it's been China. And obviously over the last 10 years, we've had central banks having a very much an expansionary policy through QE. Now, a number of these factors, I think we can probably agree, are going to come to an end. And certainly every day we talk about tapering. When's tapering going to come to the end? So I think that, inflation is going to start to certainly play a part of the narrative. And whilst the OBR says that inflation is going to peak at 4.5% next year, by the way, that is double what their last expectation was. I think here around the room we probably have an expectation that inflation is probably more structural than transitory. So within that environment, we feel that the UK, MPC, Bank of England, will probably be at the forefront of raising rates relative to the Fed and relative to the ECB. If you look at the UK economy in 2022, we're expecting employment levels to be at an all-time high. Just remember that the savings ratio is still at 20%, which is incredibly high. So notwithstanding the latest variant and the impact that might have on the economy, the kind of setup for 2022 for banks, for steepening yield curves, looks very good. And we think we're going to have at least 2 rate hikes in 2022, and that the 10-year yield on the gilt is going to be over 1.5%, so some doubling from the current levels. So I think, rates, I think, it's been delayed somewhat, but I think it's definitely going to be happening in 2022. And we think the banks with the big incumbent current account balances are the ones that are really going to benefit from that. The second is on regulation. We've seen actually quite interesting movements in terms of regulation over the last 18 months. I talked about banks being the bad actors 10 years ago, but what we've seen more recently is a watering down of Basel IV. We've also seen Russia cut the bank levy. So if we were to have this conversation, I guess, in 2018-19, I don't think we'd be coming from the perspective that actually politicians and regulators were actually looking or being favourably disposed to banks. But I think certainly that's part of the process that has happened over the last 18 months. I think there's a recognition, if I can use a slightly slang term, that banks shouldn't be viewed as a government ATM. There is a recognition that the banking business needs to be strong to support the economy going forwards. What we have seen from the banks as a result of this regulation is capital positions strengthened dramatically. The core equity tier 1 of banks, which is a measure that we all kind of look at to sort of show financial strength. If you take something like Lloyds, for instance, if I go back to 2008, it had an 8% core equity tier 1. Now we're over 17%, and that's on a much higher risk-weighted asset review. So the denominator's got tougher, but actually the number has more than doubled. Similar number for Barclays, you've gone from 10% to 15%. So we've got banks who are now, I guess, more supported by government and regulators, in stronger financial position, with, we think, quite an encouraging backdrop as we move into 2022. The last part of the equation, my last R, is return. We saw in the States with the CCAR, which is their effective stress tests, that all 23 banks in the States were passed. They have been distributing over 100% of their profits. Clearly here in the UK it's been more restricted, but what we now see is the likes of HSBC, Barclays doing buybacks, Standard Chartered and Lloyds will be reviewing their capital allocation policy end of this year, and NatWest is clearly buying back the government stake as well. So we've gone from a situation where the banks were paying out 50 billion on PPI, and there was no way in that scenario that they could be giving money back to shareholders, to a situation now where they're overcapitalised, they're giving money back to shareholders, and I think the last thing that I kind of recognise is the cost side of it. As one of the major banks said to me 3 weeks ago, 93% of our costs is related to 7% of our revenue. So this is the huge transition that we're going to go through, the transition from analogue to digital. And I think that it's not a slam dunk in terms of the cost reduction, because there will be associated costs with doing it. But I think there's a great opportunity there. And the very last comment I'll make is, the transition in terms of green transition is also going to be inflationary, but I think the banks have a very important role to play in this. And again, talking to senior executives, it is clearly a challenge when we look at Scope 1, Scope 2, Scope 3 emissions. For financials, it's all in the Scope 3, and what banks are actually going to do to address that Scope 3 emissions. It will be the challenge for them going forwards from here. But that's my sort of take at the moment. I think very exciting opportunities as we go into 2022.
Thank you, Alan. I should have said at the beginning, please do, if you're online, please do remember to submit your questions. I'm definitely going to take some from the online community and obviously in the room as well. And lots of topics that you've raised, Alan, that I'm sure we want to come back to and talk about a bit more. But let me turn to you now, Rob, definitely as a specialist. Obviously, Alan set out a pretty rosy picture for the banking sector. Do you agree?
Well, alarmingly, I do.
It's not going to make a good panel, is it? I've got violent agreement here.
I have had the luxury of following the sector for close on 30 years now. And it strikes me that there is an entire generation of fund managers and investors for whom this sector is not of investable quality. And just to give you a performance figure that justifies that statement, if we go back to the beginning of 2007, 15 years ago now, and we look forward, if I had put money into the all-share index and reinvested all my dividends, so we're looking at the total return that I would have earned, up until the beginning of this week, and I haven't recalculated the figures since then, I would have made 120% return, so plus 120%. If I'd done the same thing in the bank sector, my total return would be minus 53%. So in the stock market, which of course includes the banks in there, I would have more than doubled my money, and if I put it in the bank sector, I'd have lost more than half my money. Now, I'm going to put this into a historical perspective and say, so how did this happen? Well, the first thing that happened, of course, was the global financial crisis. Banks had balance sheets that were full of assets that turned out not to be worth what they thought they were. That made them lose a lot of money, and that just eroded their capital. The regulatory response to that immediately is, we must have higher capital ratios. How do banks raise their capital ratios? Well, the first thing they can do is they can shrink their balance sheets. And that just causes credit crunches, but at the same time, the balance sheet is where the bank makes its money. So if you shrink the balance sheet, you have less capacity to make money. The second thing you can do is retain your profits. So you just stop paying dividends. And if you were lucky enough to be a Royal Bank of Scotland shareholder, or NatWest Group as it is now, you didn't get a dividend for 10 years. And the third thing you can do is you can have rights issues. You can raise fresh capital. And that's a tough ask when you're asking your shareholders to put more money into an industry that doesn't make any money. But they did do that. And across Europe, more than 600 billion euros of rights issue money was raised over the course of the financial crisis. So that was the first bit. The second bit was QE, quantitative easing. That's life support for the economy. But from the banking perspective, QE is actually quite corrosive. And what do I mean by that? Well, QE is the process by which the central bank prints some money, it buys bonds with that, and eventually that money that has gone into the economy ends up in a bank account somewhere. Now, the banks are shrinking their balance sheets. They've got nothing, they can't lend the money. They don't know what to do with it. So normally what they would do is they would deploy that money into the upward sloping yield curve at the 3 to 5 year point. They would earn the 3 to 5 year interest rate while paying their depositors the overnight interest rate. And that differential is where banks make quite a lot of their money. It's called the structural hedge. What does QE do? QE flattens the yield curve. There is no differential between the 3 to 5 year part and the overnight. So a big chunk of the revenue gets taken away. That's bad for profitability. That's bad for shareholders too. And then the third thing that happened, if the banks had been able to eke out any profit from their balance sheets, it got taken away from them in the fines. And as Alan said, the PPI is the poster child fine. The FCA stopped publishing the numbers actually in December 2019 for how much the banks had paid out. But at 2019, the payout, actual physical cash going out to customers, was £38.4 billion. So that's where we are. That's why the banks ended up with the hatred among investors that they have. That was then. We're looking now towards the future, and I totally agree with the 3 R's. The first thing is capital has been recovered. Capital is now full. And we can see that from the stress tests that the regulators run every year, and also from the allowance that the regulators have given the banks to engage in share buybacks and dividend payments. The regulators, if they thought there was a capital shortage within the system, they wouldn't allow that to happen. The second thing, those fines, well, I'm sure that as we move forward through time, Fines will become a regular part of banking, but not on the scale that we've had in the past. So that massive headwind of PPI and LIBOR and other fines, that will diminish quite markedly. But as we said earlier, QE has been very, very painful for the banking system. Just listen to Jay Powell, that's coming to an end. QE is going to be unwinding. Inflationary pressures from supply chain problems have pushed up the yield curve a little bit, and it doesn't take much. And the banks themselves in their third quarter figures were, for the first time in a while, talking about rising interest margins rather than declining interest margins. So the outlook from here, now, it would be a problem if all of that was already reflected in share price valuations, but it isn't. If you look across Europe, banks are trading on 7 or 8 times their earnings, and they're trading at 0.7 or 0.8 times their book values. These are very close to being trough valuation multiples on earnings that are beginning to move in the right direction and go up. So we've got positive momentum in earnings, and we've got trough valuations. For me, that is an attractive investment opportunity.
Okay, we've got two bulls now. Carolina, it's over to you. You are a private market specialist, obviously, and there's obviously much more to the financial sector than just the big established banks, however important they are. So do you see attractive returns over the next year, and if so, from which sectors within the financial industry?
Thank you, and I share the thanks for inviting me to participate in today's summit. And yes, I share the excitement, but maybe for very different reasons. So just to give you a sense of where I'm coming from in the private markets perspective. So as many of you know today, the private markets as an asset class represents over 7 trillion euros in size and is an ever-growing one. So going back to your original question on general trends, I think the tremendous growth of private markets will continue well into next year. And so by way of background, HarbourVest is an 80 billion AUM specialist in private markets. And where we see shared excitement, I guess, for the opportunity in the financial sector is the innovation and transition that Alan initially alluded to. So for all the opportunities that Rob highlights in terms of the challenges that this segment has gone through, and by no means am I a financial sector specialist, but we have seen continued interest in the transition and the innovation behind what will drive that transition, particularly on the digitalization front. And that is something we've seen in terms of the percentage of capital in private markets going to these types of investments and the sector wholeheartedly. So if you take back 2 decades ago, financials represented about 2% of where private equity was investing. Today it's anywhere between 14 to 16%, outlining the interest in the segment. Fintech is obviously an area which I can come back to in more detail later, but it's a segment that's growing very quickly and generating some interesting companies that today are valued higher than many of the banks that we're discussing. So it is very much a growing element of the financial services sector, and one that I think will continue to drive some of the challenges presented earlier in terms of legacy technologies in these banks, their ability to capture some of the opportunities, enhance the customer experience. A lot of the things that will drive profitability for the banks will be backed through innovation in the private markets.
Great. Okay. Well, we've got 3 very optimistic people here, so this is a little bit of a worrying. Often, it pays to be a contrarian. So there you go. But it's very compelling, all your arguments. And I want to pick up on a few of the points that you've made between you and delve a bit deeper. Alan, you mentioned, that bankers were seen as, I think you said bad actors rather than evil, but and very much the causation of the global financial crisis, greed and so forth. And you also talked very warmly, though, of perhaps how they've rehabilitated themselves and had the opportunity to do that since the pandemic. Can you just elaborate a little bit more on how you evidence that, in terms of what they've done to step up, what role they can play as we try to recover, at least economically, from the pandemic, and perhaps elaborate a little bit more on culture, because none of you have mentioned that word, and it obviously still comes back to bite. When you look at Barclays and so forth, there's questions, might be an individual there or it might be wider, but it still seems to be a running problem for the finance sector.
Yeah, no, they're very good questions, Helena. I think in terms of the comments around, bad actor, I think we probably all agree, and Rob made the point very eloquently about what they did back in the global financial crisis that had largely brought it on. I think if we roll forward to the last 20 months or so, clearly there's been a lot of government support that's clearly helped businesses, individuals survive what's been an incredibly stressful time for basically everybody. And I think the banks have played a very important role within that. I think that there's, we know about, some of the issues around, mortgages and allowing people to take time to pay mortgages, landlords, businesses, business loans, the rates that they've been charging for these loans. You're not reading anywhere about people being forced to foreclose, things like that. So I think the banks have been quite smart, and they've taken the opportunity to say, come on, this is a great opportunity for us to rehabilitate ourselves in the eyes of the public. As much as banks can, let's be very clear that they're never going to be your best friend ever. But I think there was a very big gap, particularly after PPI and the negative implications that had for a lot of the savers who banked with particularly the large banks. So my view is that they have rehabilitated themselves to a degree in this process, and I think that now swings to being a supportive role in the economic expansion, which, post-Brexit, let's see what happens to the economy there. I think clearly the pandemic has masked some of the potential impacts of Brexit. As we roll through 2022, we might get a clearer picture, hopefully, of how the economy is looking. But certainly, economic growth in the UK looks very compelling within a G7 and a G20 context. We are looking at sort of nearly 7% growth this year, maybe 5.5% GDP growth next year. So I think the banks have their role to play in that. I think you make a very important point in terms of culture, and we have had quite a few changes at the top, and I know that doesn't necessarily mean that culture extends down through the organisation, but I think culture starts at the top, and I think unless you've made changes at the top, then it's very difficult to instigate change as the business going down and cascading down through the business. So I think there's when I meet the bank CEOs, senior management is clearly one of the up with ESG, and I'm sure we'll come and talk about the environmental responsibilities banks. Cultural change is one of the key things that we talk about, and how they can demonstrate that to the public and to investors alike.
Do you think they should be doing a little bit more on communicating things? And when we're here as guests of Edelman, and it just seems maybe they're smart not to trumpet too loudly all the quiet things they've been doing to support individuals, businesses, etc. But do you think they could do a bit more to seize the moment?
I think it's dangerous saying that in a sort of PR firm, isn't it? But I think I think there are times to be very public and there are times to be quiet. I think that the struggles that individuals have gone through over the last 20 months has meant I think it's probably appropriate to keep a relative low profile and do things behind the scene.
The evidence. Yeah.
I think as we move into 22 and hopefully we kind of transition a little bit out of the current situation, I think there's an argument for them to be much more on the front foot and evidencing what they've been doing. But I think right now is the right time still to be kind of keeping a low profile.
Quieter. Well, it'll be very interesting to see when you do your next Edelman Trust Barometer whether the banks are better trusted after the actions they've taken. Can we move on to discuss the funding of the move towards a lower carbon economy? Because obviously that's a very hot topic as well. Sorry, that's a bit of a pun, but I didn't really mean it to be like that. But obviously financial institutions can also be somewhat torn here because often they have relationships with companies that are old energy companies, as it were, or part of the fossil fuels that obviously we're looking to phase out. Rob, do you see this, well, first of all, I suppose I'm most interested in how you incorporate that issue into your analysis and how you see both the risks and opportunities for the financial sector.
Clearly, banks do have large exposures to existing oil and gas producers, and what they can't do is just call those loans back in. You can imagine the problems we would have where we couldn't find HGV drivers. What if the HGVs didn't have any diesel? This would be the end of the world. So what we need to look for as we analyse the companies is they have a plan as to how they can move to financing the transition. And thankfully, the banks have got lots of capital, they've got lots of deposits, and so they have the capacity to be able to lend which they didn't have in years gone by. So there's plenty of capacity to lend, and what we need to see is a plan through which they help these companies, and all the companies want to do it, to move towards a green economy and away from their old fossil fuel routes. But you can't just cut off the old stuff yet, because we haven't got enough new stuff to replace it.
So that's in danger of being perhaps a bit misunderstood, isn't it? That you might get headlines around, financing of.
Well, that's right. You get headlines that Bank XYZ has lent, so many billion to oil company ABC. Well, yes, of course they do. These are massive companies, and they do require financing to keep the lights on.
But perhaps they need to work on the forward-looking agenda at the same time.
And that is crucial. Yes.
And Carolina, you're something of an ESG specialist, and obviously you have the opportunity to invest, in non-legacy sort of situations. So how are you factoring this issue into your assessment of what are the best companies to be investing in?
I mean, it's an incredibly important point. I think ESG is at the forefront of many investors today, and it's really across all sectors, so it's not just the financials. But there are elements of the financial sector, be it the insurance companies, that have taken a very proactive stance towards, be it coal or other energy segments. The opportunity of being in private markets is, yes, typically we are funding companies at the innovation side. So again, the transitional energy that will hopefully procure a greener future for all of us. But that is to say, there are still traditional industries and that private equity is backing. And I think what they're doing there is really incorporating a lot of the disclosures around and really monitoring of what the carbon footprint of their investments are, of their activities are. And if you start tracking it, then how do you progress to improve it? So I think there is probably a transition phase for all sectors, and financial one included. But we can start by really understanding what the impact is of the businesses and communicate the progress being made with underlying investors.
Great. So I'm going to ask one more question generally of the panel before I turn to the virtual and real life floor. So you are forewarned. But I do want to carry on the conversation with you first, Carolina, because I know that some of the people who are dialed in or are in the room are interested in funding opportunities for sort of pre-IPO companies. You're obviously an expert there. Can you just set out a bit the lie of the land in terms of where you see the market, the opportunities, the things that people should be considering as they perhaps weigh up different alternative routes?
Yeah, I think there's tremendous growth in what is the private markets funding, and particularly where we hear a lot about kind of pre-IPO valuations. Those are in the fintech space. And so just to give you a little bit of context in terms of venture-backed fintech funding in Europe, in the first half of this year, the number's around 10 billion euros that was raised to invest in these types of investments. And that's 1.5 times what it was last year. And last year, the European share was about 30% of global fintech investing. So it is definitely a growing segment. And these investments, obviously, a few years down the line, will hopefully generate companies like the ones that we saw list this past year, like Wise, which had a very successful float here in Europe. We obviously have companies that are very much in the headlines, companies like Klarna that remain private. It is one of our direct co-investments into very successful buy now, pay later companies. And there's other very innovative models that, again, going back to the initial conversation around where the opportunities lie in the financial sector, it is about changing how these financial firms can interact with underlying consumers or customers. And so I think when you are able to articulate that business model, when you're able to provide solutions to even the banks, if you can collaborate. So JP Morgan Chase announced their collaboration with a cloud company that Thought Machine was called. It's a bank with $3.7 trillion of assets with multiple retail chains across the states, and they partnered with a UK fintech company that's going to help them put most of their core activities on the cloud. And this company didn't exist before 2017. So it just goes to show how quickly a company can become a big part of the solution in some of the challenges and the innovation required to bring the financial sector forward.
Wow, that's a very speedy rise, isn't it? Okay, let's turn to questions. I'm actually going to turn, because I gather you ran out of time sometimes to take them from the online audience. So I'm going to ask first off if there are any questions that have come through from those who are listening at home or in their office?
Great, thank you. Yeah, we've got a few questions here. The first is from Mark Wood, and it draws on your point you made, Alan, around the kind of opportunity around from analog to digital. And the question was, can incumbents reap the analog to digital dividend, or will innovation come from the disruptors, the startup fintechs? And then slightly linked to that, there was another point made around people with a background with technology and operations cropping up more in mainstream lenders. The new boss of Barclays being a point, he's got a background in kind of computational analysis. What skills are you looking for on the board of companies going forward? And is digital transformation and the ability to kind of combine those worlds a must, that you're looking for? And then finally, there was a question around, is cyber risk a major risk consideration, of which is being drowned out by climate concerns?
Wow, 3 fantastic questions, I think, there. So, Alan, I'm going to ask you, since that question was partly directed to you, it seems, in terms of, this challenge that incumbents have in terms of embracing the fully digitized model. Is it doable, or are we just kind of, they're marking time, and is that going to be overhanging them and perhaps denting this positive outlook because there's so much of a threat from the...
Yeah, it's a great question. It's a great question. I mean, we know with banks there's a lot of inertia. How often do people move their current accounts, et cetera, et cetera? A couple of things strike me. One is with the sort of, the digital fintech companies. A lot of them are loss-making. We know that bank profitability tends to anchor around current accounts and the ability of current accounts to fund mortgages being obviously one of the most profitable lines of business. And what we're seeing is a lot of the fintech companies applying for banking license to try and attract current accounts. I think the evidence is pretty thin on the ground that that's been a successful move thus far. So I think that's an issue for them. The second point that I very much reminded of what you were talking about is we were investor in WorldPay back in the day, and that was merchant acquirer that came out of Royal Bank of Scotland. These businesses have fantastic digital businesses sitting within them. And every time we talk to management, it is around this digital translation or transfer of costs. And I think the banks kind of hide their light under a bushel. I think there are lots of these businesses within the likes of the Barclays or the Lloyds or whatever you want, what examples you want to give. And I think that the bank senior management are now understanding this. And I think the more and more we push them as public market share owners of these businesses, I think the more they will talk about, the more we get more comfortable with that transition from analog to digital. So I think it's in their gift to do it. They need to talk about it a bit more eloquently, and they need to demonstrate it. But I think it is there.
Carolina, can I bring you in this? I mean, I'm intrigued by the inertia point that you mentioned, or I want to pick up on that, because I think people are inert often as well and don't shift, even if there's a better opportunity. And I remember going around Starling Bank. Anne Bowden gave me a little tour a couple of years ago, and she said the typical customer was, a man in his 20s, and the fewer women in their 50s like me were banking with them. So is there a risk for the new players that they can't get that market share even if they're offering a better product?
So can I just make a comment quickly before we transition to that great question? Just on the comment on WorldPay, because that is a phenomenal private equity success, where there was a legacy kind of IT infrastructure that had been underinvested by the owner at the time, and private equity was able to come in, reposition the company, put significant investment to drive that technology, and today, it's a fantastic business. And like that, I'm sure there are great assets within the larger banks that, because of all priorities and strategic vision, have maybe been underinvested. But so when you think about the opportunity, going back to new banks, and be it digital wallets, mobile banking, there is a generational shift in behaviors, and I think a lot of the younger generations are very comfortable going, and not gender specific, across the board, going on to the likes of Revolut, and banking with them. It's right that there might be a portion of the banking clients that probably aren't going to transfer or big chunks of their capital over to these types of banks, but I think there's certainly a lot of scope for growth. And it's true that these companies may not be profitable in order to fund that growth, and so there is a maturity that needs to happen. But I think the markets are reflecting in the valuations particularly a lot of the payment processing companies like Adyen, which is valued the same as a BNP Paribas. That is reflecting the growth and the potential. And where we've seen tremendous success in private equity-backed companies is in the payment processing as a way to capture that growth.
So clearly it's the future, isn't it? So it's just a question of time, you might think, in terms of when that switch is going to happen. Can I turn to you, Rob, about the question on boards and people with back or senior management positions as well, presumably, because it seems that almost every company these days is a technology company, unless it's your local butcher or something like that. I don't eat meat, actually. That was a bad example to use, but there you go. But is it, obviously banks' board members were one of the, accused of contributing to the financial crisis because they weren't sort of overseeing companies properly, and there's obviously been a lot of change in what's seen as a good board, what the matrix of skills needs to be, and also with senior management. So is basically everyone now a technology specialist, or is that the desirable characteristic? And also, as an analyst, do you look at the boards closely, and do you look at the qualifications and of the different members of the board?
Yes, we do. I just wanted to make one point on something that Alan said. A lot of the fintechs are loss-making. And that, I think, is quite important, because when you look at something like a Revolut or a Monzo, the losses are large, more than £100 million a year, and climbing. And I think that the crucial point here is these may well be disruptive products, and it's easy to be disruptive while you don't have to make a profit. But if you need to make a profit, you have to start charging your customers in some way. And I just wonder whether that transition, how much, I don't think people sit at home on a Sunday afternoon browsing the internet to look at what's the best bank offering I can get at the moment for my current account. They may look at cars or TVs, but probably not banking. Banking is a utility product, and I don't know how much people are prepared to pay for it. And that's the experience we've had in the UK. But coming back to the qualifications of board members, banking is a digital business. There's very little physical banking left anymore. And so the ability to be able to, in particular, protect your customers' deposits. And I had a very interesting conversation with the chairman of a very large bank once, and I put it to him, I said, why is it that technology companies who seem to get hacked quite a lot, and yet either we don't hear about it or the banks aren't getting hacked a great deal? And he said, I think it's just a mindset that as far as technology companies are concerned, the world out there is a wonderful thing that needs to be connected with. And so they open up their portals and everybody rushes in, and you get the bad apples come in as well. Banks, on the other hand, have always had the view that the world out there is big and ugly and scary. And so they build very, very strong walls around everything they do. And that is a mindset. And that, I think, is the way that bank boards have to think about things. It's all very well having open banking, but you do have to protect, and make sure that your APIs are secure. And that kind of background, I think, will become more and more important.
And that segues nicely into the third question, and obviously this is the final one from the online community, so be warned, you have the floor shortly here, on cyber risk. And perhaps I can ask you, Alan, whether you agree with Rob that banks are onto this, or whether it's just, I do think there are a lot of unknowns about cyber risk, and it obviously is a big threat. What's your view on this on a relative basis of all the things we've discussed in terms of its importance for the outlook for the sector?
Well, it's people's savings. It doesn't get any more important. If people, suddenly feel that their money isn't safe in a bank, that causes the run on the bank, and that's obviously
it's the ultimate confidence risk.
Yeah, you can't have that, clearly. So I agree with Rob. Obviously, that the robustness of the systems clearly are in place. Yes, we hear of sort of ATMs go down or networks go down for short periods of time, but we don't hear about the cyber attacks, which are increasingly impacting on other industries and other sectors, and sometimes quite random related stocks that you wouldn't necessarily think would be obvious. Companies to have cyber attacks. So I think the banks clearly have, to my slightly uneducated view, have very robust systems in place, and clearly it's paramount importance that they can maintain those to maintain the confidence of their customers.
And quickly from you, Carolina, because obviously small startups, as private equity investments start up very, maybe a couple of people. When does cyber risk become on the agenda, and how do you again assess that if you've got a very big focus on growth?
No, I think cybersecurity is front and center of any business today, and from the outset, protecting ultimate clients' personal information and more broadly in terms of the business risks associated. So it's very, very important, and I would say, that's where the regulatory environment does protect ultimately consumers and businesses of users of these fintech solutions, because there is an emphasis that cybersecurity is very important in terms of protecting the ultimate customer.
Alrighty, so let's go to the audience that's here, the live audience. Yes. I don't know how it works. You got a microphone there, so that's good. So.
Thank you. I was wondering if the panel had a view on the growing imposition of climate stress tests and mandatory scenario analysis by central banks globally, and what that means in terms of the future of the industry, because we did see the results of the ECB climate stress test where they made the point that none of the banks had essentially met the performance criteria they'd laid out.
Any volunteers?
I'll have a go. I think it's a great question. I think that, one of the things we do at Lazard is obviously we have a significant ESG team. Our views on ESG are integrated into our process and our views on stocks. The struggle for us is when we're looking at scope 1, scope 2, and then scope 3. Scope 3, as I mentioned earlier, is the big deal for banks. How do they go about reducing their scope 3 emissions without, as Rob's saying, cutting off the lines of credit to big companies? Is it airlines? Is it oil and gas companies? Is it? But it doesn't stop there. It's not as narrow as some people would like to make it out to be. And so I think that is the real challenge. And obviously now that we are laser focused in on these deliverables and net zero and the dates, etc., I think we are going to see more information from banks on how they're looking to reduce these scope 3 as well as scope 1, 2, which are obviously quite small in the context of their loan book. So I think, yes, we are personally putting a lot of pressure on them to understand and to talk about how those numbers are going to evolve over the medium term.
And the gentleman behind.
You asked for a contrarian view, and perhaps a slightly cynical one, so may I provide it?
Please do,
May I try? And try to link it back to governance, actually.
Yeah.
Rob, you made some very good points about the appalling returns in terms of share price performance. And I've run global banks research teams in the past, and I never understood why anybody listened to me, because banks seem to be a perfect model of transferring capital from shareholders to their employees. A brilliant model at doing that. You want to work for a bank, not own one. Now, last year, the regulators put restrictions on income for you guys in terms of dividends. And their rationale was that we are supporting the banking industry because we want them to provide a service to households and corporates, not to give money to shareholders. They've relaxed that now so they can pay dividends. But this year, if you look at the returns that banks have done, the revenue line has been pretty poor. Yeah. The costs are up. So why have banks generated returns this year? Their provisions have been lower than expected. Why? Because they've been supported by governments. And their investment banking returns have been great. Why? Governments and the shape of the yield curve. Mm-hmm. So a lot of the returns this year are being driven by exogenous factors, not factors that relate to the quality of management. And equally, Alan, you made this point about the productive role of banks. The stock of productive lending in Europe now is lower than it was in 2009, after the global financial crisis. So all of the lending that has taken place has been to generate returns in real and financial assets, and that has negative implications for income inequality and financial stability. So from a governance perspective, why are the boards and the CEOs of these institutions going to be paying themselves so handsomely this year for what is essentially being returns that have been driven by exogenous factors?
All right, good challenge. Rob, Hugh.
Yeah, shall I kick off? It's absolutely true that a lot of the returns or profits this year have been generated by things like furlough. But equally, it's true that a lot of the profitability has been destroyed by things like quantitative easing. So we give with one hand and we take with the other. But I think my view was very much that QE was life support for the economy. But it had the unfortunate effect of virtually murdering the banking system. And so as that life support is removed, yield curves should bubble back up again, and the banking system should be able to make some money. Now, in any economic world, the banking system needs to be able to cover its cost of equity. Now, we are trading in valuation terms at 70 or 80% of our tangible book value. That is not going to attract capital into this sector. I'm not going to invest money into a sector where each pound I put in is worth 70p to me. So we need to see the returns in the banking sector bubble upwards towards beyond 10. I mean, in my world as an equity banks analyst for the last 25 years, the cost of capital for the cost of equity for the banking system has always been a nice round 10 because it makes the calculations easy for no other reason other than that. And it seems to be a number that, if you've got a PE of 10 and you've got a cost of equity of 10 and your growth is roughly nil, then that all sort of hangs together quite reasonably. So if we are trading at 70% of our tangible book value, is the cost of equity really now 15 when for the rest of the world it's virtually nothing? So I hear what you say, why, if all of the profitability has only come from the government, well, it was the government that took all the profitability away. So I think we are looking back over the last 15 years is not looking back over a representative period.
You can talk about that later, I think. I know there's one more question. Are we allowed one more at a time? One more, okay. And then...
Just a very quick one. I wondered whether there's an opportunity for private equity to step in to fill in the gap left by the banks.
In what context?
Well, it's been difficult for the banks to lend. So how can private equity step in with, private money in the private market to, lend to companies that otherwise wouldn't be able to get funding?
Carolina, one for you.
So the part of what's fun, the growth in private markets is definitely the opportunity to step in and provide funding for small businesses. So there's obviously over 10 times as many private companies as there are public equity ones, and those companies definitely need access to capital. So I think particularly in the private debt market, we've been able to see a lot of activity funding the growth, and in private equity stepping in, not just we talked a lot about more the venture-based lending but, and funding, but there's also a significant portion of the buyout sector that will fund small businesses.
Terrific. Well, thank you so much, Carolina, Alan, and Rob. You've been fantastic panelists. Thank you so much for the questions, both online and here in the room. And I'll close now, and I believe there's a short break before the next session. Thank you.